months ago, we did a YPN short sale BPO seminar here, and at the end of the seminar, we did a residential and commercial update. It was pretty popular. We got a lot of good feedback on the two reports, and we decided to get the information updated and bring it back here for today's seminar. So I'll be going over the residential housing market and just some of the local, regional, national changes and kind of what's going on. So first we'll cover local changes. We have the City of Pinole. They're going to be imposing the sewer lateral ordinance by the end of the year. Very similar to what the other cities in West Contra Costa have been doing. The Local Government Relations Committee here at the West Contra Costa Association, they are working with the City of Pinole in trying to make it an easy transition into the process, and it's great that the City of Pinole is trying to work with us, because as you all know, the other cities just imposed these ordinances without really getting realtor input. So it's nice that City of Pinole is actually talking to us, and we are trying to help them make a great system. So on a California level, Governor Brown signed in the HOA law 771, and what this is HOAs are required to provide prospective buyers of certain HOA documents. The problem is that a lot of these HOA companies don't have the manpower to be providing all these documents, so they've been assigning third parties to sell these documents. These third-party vendors are exempt from a lot of the rules that HOAs are required to follow when it comes to charging prospective buyers. So they've been bundling a lot of unrequired documents in the HOA packages, and that's why some HOA fees during purchases are $600, $700, or even $800. So this was changed, and Governor Brown signed in Assembly Bill 771, which prohibits the bundling of unnecessary documents and states that only fees associated with the required documents can be charged. If the buyer wants additional documents, they can pay the additional fees to get any additional documents.
The form for that is being amended to show only required documents. The homeowner disclosure form and WIN forms that you order the docs from,
yeah,
it's coming out with the amendments to reflect it.
Okay, next thing, short sales in California, deficiencies are now illegal. And the California Senate Bill 458 was signed on July 15th, which stated that junior lien holders, which are the second mortgages or HELOCs, if they approve of a short sale, after the short sale, they cannot go after the former owner for a deficiency judgment. Okay, so this was definitely great for owners doing short sales, but it may have unintended consequences, because one of the big things for these junior lien holders when they approve the short sale is that they had an option to go after the former owner to collect anything that they can. Well, if they approve a short sale and they give up their right to go after the homeowner, they may not approve a short sale now, because in a foreclosure, they now have the option to go after the former owner for a judgment. So that's just one thing to watch. It's still new. You know, we just had a couple short sales personally approved with a second loan on it. So you know, we'll just have to kind of watch to see how that goes. But junior lien holders would technically, in theory, could delay short sales or deny short sales to go after the owner. Is it illegal to remove your own appliances in a house? Technically, you guys probably seen this photo of someone trying to steal an appliance. Is your client in the short sale or foreclosure process? Can I take my appliances a common question, which normally it is. And just be very careful how you respond, because once a property is listed as a short sale, it becomes, under California law, a distressed property sale. Yes.
What if you put in the MLS, but none of those appliances stay?
Doesn't matter, because once you list the property as a short sale, okay, what 1872 law in California states that the occupants can be removed for or prosecuted for removing attached appliances, because these appliances that are attached to the property are technically real property, and during the distress sale they would belong to the person they owe credit to, which would be the bank. Yes.
Generally, refrigerator, washer, dryer, and those are like regular sales. So are those still?
Refrigerator counts as an appliance in this situation. A washer and dryer, I don't believe it does, but mainly it's a refrigerator, stove, dishwasher, and if there's an installed microwave, anything, a built-in oven, built-in stove, those type of appliances, yeah.
Yeah, you just plug that in and out.
But once it's plugged in, and the same thing with the stove. Once you plug it, you can unplug it and move it out.
It's attached to gas lines and
Yeah.
all that other kind of stuff.
Yeah,
Have water lines. Refrigerators have water lines.
yeah. Some have water lines and
Like mine.
yeah. Now, in the packet that everyone has, there's a letter from the Contra Costa District Attorney that states what appliances can and cannot be taken, and it'll give you a lot more info. So when a client asks you during a short sale, hey, can I take my appliances? Well, refer back to that letter. It's like a 4-page packet, and it'll tell you exactly what is allowed and what is not allowed. So be very careful, because if you're advising clients, yeah, you can take it because property's technically yours, but if it's listed as a short sale, you may have a problem there. I haven't heard of the banks going after anyone for that, but they can be prosecuted. Okay, QRM. The qualified residential mortgage. How many of you are familiar with QRM? Okay. There's just 2 people here. Okay, so QRM stands for Qualified Residential Mortgage. It was created by the Dodd-Frank and Financial Reform Act. The history behind this is when banks originate loans, they sell these loans on the secondary mortgage market. They'll sell them to different investors, Fannie, Freddie, and a lot of times these loans are packaged and sold off to one or multiple investors. Now these loans may be securitized and packaged with other investments such as stocks, commodities, etc. The problem we had when the market was booming, the securitization process was the bread and butter of the banks. They were making lots of money. A lot of the bad loans were hidden in these securitized packages. So the main goal of the Dodd-Frank Act is to prevent from any of these bad loans from being packaged and securitized by the banks, by Fannie, by Freddie, or any of the big financial institutions. So QRM was pretty much created to prevent risky loans from being packaged. Now, the problem here is that the creators and the enforcers were trying to impose a 20% down payment requirement for the buyer in order for this loan to be a qualified residential mortgage. If it's a QRM, if it's a qualified residential mortgage, then the loan can be securitized. If not, if it's less than 20%, then the bank has to hold on to a large percentage of that risk. Well, the banks are in the business to make loans, package them off, and then they hold on to the mortgage servicing rights. They're not in the business to hold on to the actual risk of the loans. So, and you can imagine a 20% down payment requirement for buyers is a big deal, because how many people really have 20% down payment? Very few people. So NAR, CAR, lots of other real estate business, the real estate industry in general is trying to fight against the 20%, trying to get that reduced at least to 10 or back down to 5, or just get rid of that 20% requirement. Especially nowadays with FHA trying to cut back on their market share. Their market share was huge and still is huge, and they want to cut back down to 50% of what they're operating at right now. That's a big deal because you're going to be pushing a lot of these FHA buyers to conventional financing, but then you're going to impose a 20% down payment requirement. Now, everyone was hoping for a decision this year on QRM, but that decision is being delayed until 2012 by the Consumer Finance Protection Bureau. That's pretty much, I guess they're not the official decision maker, but they're the ones that they're really looking to for guidance on this. So REO foreclosure inventory. Everyone keeps asking, where's the inventory? What's going on? What's happening? Because we all have buyers that want to buy these REO properties, dirt cheap, or we have REO assignments that we're not getting as many as we used to, or maybe some of you just got approved by banks for REO accounts but haven't received an assignment. So I saw this picture here. I thought it was pretty funny. It's a for sale sign that says foreclosure stopped by owner. Well, and none of these foreclosures are really being stopped. They're just being delayed. So stats according to LPS, Lender Processing Services. I found these to be pretty amazing stats that came out last month. There are 6,538,000 loans that are 30 days past due. Okay? Now these are 30 days past due. Now, of those, almost 2.2 million of those loans are in the foreclosure process, meaning notice of default or notice of trustee sale. Okay, that's it. I mean, that means about 4.4 million loans have not even started the foreclosure process and are 30 days past due. Okay, and we're not even talking about the loans that are just readjusting right now and that are set to readjust next year and the year after. Because remember, a lot of loans in 2005, 2006 were set with 5, 6, 7 year interest only payments, and they're set to readjust in the next coming years. 2010 had a record level of foreclosures taken back from the banks at 1,025,000. 2011, I haven't seen the numbers for, but it seems like it's going to be lower than that with all the delays. Do the math in how many years of inventory we have for foreclosures. So what are the reasons for delayed foreclosures? There's a ton of reasons. There's the fraud, robo-signing, sloppy paperwork. We've all seen the news articles on TV. We've read about them. We've read about, what was her name? Was it Debbie Denise or something? Where there was a guy who signed 10,000 Debbie Longs on on foreclosure paperwork. So you've got those situations. MERS, the Mortgage Electronic Registration System. About 60-70% of all the loans that were generated during the big boom had the MERS clause into the loan package. This was a way, because when a bank sells a loan, they're technically by law supposed to record it with the county, provide notice to the owner. Well, MERS was created by and it's actually owned by the big 25 banks and financial institutions, where it created a tracking system for these loans. So an owner could contact MERS, give them their loan number, and they would know exactly who the investor on that loan was. The problem is, so many loans were done under this, and some of it was done, sloppy paperwork. Now, not all of it was sloppy, and MERS was a good tracking system. The problem today is that the way the loans were set up, MERS had the right to foreclose on a lot of these loans. Well, the argument in court is, how do they have the right to foreclose when they have no financial interest in the loan? Because they're just a tracking system. They're not an actual interested party in the loan. So they've been winning battles 50-50. They've lost some battles, won some battles. I guess MERS was just tired of battling it, and just a few months ago they announced we're not foreclosing on any more properties from now on, and all the paperwork is now being switched back to the banks so that the banks can now foreclose. So that's creating a lot of delays. Owner lawsuits, class action lawsuits, of course, the person who says they haven't paid for 5 years, but the bank is out to get them. Those type of lawsuits. You've got class action lawsuits where individuals are getting together, and you've got investor lawsuits where the investors are tired of the banks messing around, charging them lots of money in mortgage servicing rights, found out that the banks did these shady deals, and they're going after the banks to buy back their investments. Of course, politics, government regulations, interventions, this doesn't help. Everything keeps, any new regulation that imposes more stuff for the banks to do keeps delaying all the inventory. Bank accounting practices. That's a big one that I really don't see a lot of people talk about, is the whole mark-to-market rule change that they had back in 2009. Before, when a loan went into default, and I believe it was after 90 days in default, the banks had to report it as a loss. And that's why you saw back in 08, 09, a lot of banks going into the red. Well, that rule was changed to where they don't take the loss until they actually sell it. So they can foreclose on a property, don't have to count it as a loss, and when they actually sell it, then it becomes a loss. So a lot of these delays benefit the banks in several ways, including accounting practices and mortgage servicing rights. When a bank creates a loan and they sell it off, they hold on to mortgage servicing rights. It's like property management. You're collecting a fee every month for servicing these loans. Well, the fees go up during a default because they're spending more time doing valuations, trying to contact the people, and of course mortgage servicing rights right now is bread and butter of the bank. Dodd-Frank Act is trying to get that change, and they're threatening. I don't know how that's going to go. We'll probably have to wait till next year. And now, last week, the OCC, which is the Office of Comptroller of Currency, reviewed 200 loans and found out that they needed an independent review of 4.5 million foreclosed loans between January 2009 and December 2010. These are loans that already got foreclosed on, and a majority of these houses have probably already sold. Now they have to do an independent review where they're going to be contacting the former owners through mailings, through tracking services, through advertisements, and an independent review will determine whether there was any wrongdoing by the banks, and if there was, then they're going to review each case individually for restitution. So that's going to be a big thing to watch, because they announced it last week, and the board of directors of all the top 14 banks that were mentioned have already signed on to the regulation that they're going to follow it. And that's it for the residential market. So I'm going to pass it over to David here, and he'll go over the commercial.